everyone. I trust that all of you have had a good day. I'm going to lecture here on chapter 4. This is going to be a very simple chapter for you because it's mostly concepts you already know. We're just going to apply it to merchandise, retailing, to stuff you buy. Up until now, we've been talking about service organizations, accounting firms, law firms, consulting firms, plumbing services, lawn services, and then we account for their time. That's what they sell is their time. But now we're going to start talking about stuff you buy. I talk about tennis shoes and bicycles a lot, so because we all understand tennis shoes and bicycles. So far, as we've been looking at our income statements, we've had revenue minus expenses equals net income. That's been really simple. You guys all understand that. It's just a little different for a merchandiser, not a lot different. As you know, there's a supply chain for goods, manufacturer to wholesaler to retailer to consumers. What we're talking about in manufacturing works for a manufacturer, a wholesaler, or a retailer, because we're going to talk about inventory and how to account for that and the cost of inventory. Pretty simple concept, so this is going to go pretty quick. We'll be done here in about 20 minutes. So when we talk about our income statement, and you can look at the income statement on the lower left for a tax service, that's services like we've talked about up until now. You have your revenues minus your expenses equals net income. You guys all know that. When we talk about a retailer, we have to add the cost of goods sold in there. So our merchandising income statement has your net sales, which is that total revenue that we talk about, minus the cost of the product. So if we purchase a pair of tennis shoes for $60, we purchase a pair of tennis shoes for $20 and we sell the tennis shoes for $60, the net sales or revenue is $60. Cost of goods sold is $20, so our gross profit is $40. And then you subtract the operating expenses and get your net income. So we're just adding that cost of goods sold and gross profit in there. So if you look at the Nordstrom income statement on the right, you'll see that it shows net sales minus cost of goods sold. Then you get to the gross profit. And then you subtract all those other operating expenses and get to your net income. So I think you're going to find this pretty easy to understand. This is the operating cycle for a merchandiser. They buy products, tennis shoes, bicycles, whatever it is. They sell it, sometimes for cash, sometimes on credit, so they have accounts receivable. They collect their cash, and then with that cash, they buy more inventory. They sell that, cash or credit, they collect their cash, they buy more inventory. That's just how merchandisers work. You will find out that as we're trying to keep track here of our inventory system, I'm going to give you some numbers here, so I think that helps you understand. We start with a beginning inventory of, let's say, $100. During this accounting period, we make net purchases of $200. So our total merchandise available for sale during that time period, during that accounting period, was $300. So during this accounting period, our merchandise in our store available for sale was valued at $300. At the end of the month, or at the end of the accounting period, this $300 is either going to be accounted for in your ending inventory. So we're going to say our ending inventory is $50, and the cost of that inventory that we sold was $250. So beginning inventory, add purchases, total merchandise available for sale, and at the end of the accounting period, it either is an ending inventory or cost of goods sold. Later on, when we talk about inventory assumptions down the line, you'll find that we have several options for accounting for inventory, but it will end up at the end of the month that it's all either in inventory or in cost of goods sold. So that never varies. So there's a few amounts that go into your inventory purchase. So we're just going to go through some examples, and I think that'll help you understand them perfectly easily. On November 2nd, we purchased $500 worth of merchandise inventory. debited merchandise inventory. That is an asset account. It is a current asset account. We paid cash, so we credited cash, and our explanation was purchase goods for cash. Sometimes we get credit terms. It's just called terms. And what credit terms mean is that you've purchased it on credit, so you have an accounts payable, but the company says if you'll pay it in a short amount of time, in a discount period of time, we will give you a discount. So this is what a term looks like. It's in a little bit I'm going to show you an invoice, and I'll show you where the terms are. So this says it is always written this exact same way. Discount percent / number of days, comma, net amount in this amount of days. So what this purchase discount says is you get a 2% discount if you pay it in 10 days, or you pay the full amount, but you have to pay it within 30 days. If you exceed that 30 days, then you pay a penalty and usually interest. If this said 1/5 net 60, your percentage would be 1% in 5 days, the full amount due in 60 days. So those terms, if you pay it within that discount period, it reduces the cost of your inventory because you got a discount on it. We used to have friends that owned a grocery store, and they purchased about $1 million of groceries a year, and they were complaining because they never made any money. And I said, well, what are your terms? And they said, oh, they're usually 210 net 30. And I said, well, you make at least $20,000 there just on the purchase discount. And they go, oh, we're never able to pay it in time, pay it in the 10 days. And I thought, oh my goodness, you're giving up $20,000 a year of pure profit because you don't get your purchase discounts. So a business needs to be healthy enough to pay within that discount period in order to make that extra money. So this is how you account for cash discounts or terms when you're making journal entries. Merchandise inventory, same $500 worth of merchandise inventory. You debit merchandise inventory, a current asset account. You credit accounts payable, a current liability account. Your explanation is purchase goods, terms 210 net 30. So it was purchased on November 2nd, so it means you have to pay it by November 12th. Okay, so here's what an invoice looks like. And if you'll look down at this middle line right here, it shows the date you ordered it, the salesperson, the terms, 210 net 30, freight, FOB destination, and how it's going to be shipped. Later, I'm going to tell you what that freight term means, but right now, let's finish up with trade discounts. So if you pay it within the discount period, they paid it here on November 12th, so just on the last day, and that's fine. Accounts payable is credited, so our accounts payable is cleared out, and merchandise inventory is reduced by $10 because we got a 5% or a 2% discount, and then cash was $490. So we saved $10 on the cost of our merchandise. And this is how your ledger accounts looked. When you purchased merchandise inventory, ledger accounts or T accounts, don't forget, on November 2nd, you debited merchandise inventory, you credited accounts payable, your current asset and your current liability. When you paid it on November 12th, you reduced the cost of the merchandise, so you credited merchandise inventory and you credited cash by $490, and you debited the accounts payable. So you paid less for the inventory because you paid for it in that discount period. If you pay it, let me go back. If you pay it after the discount period, accounts payable, the $500, cash $500, it does not affect your merchandise inventory cost at all because you didn't get a discount. So there's a couple of other types of discounts we're going to talk about for when you purchase merchandise. One is a purchase return. If you purchase merchandise and it's just not what you want, then you return it. Just like you return things to a store, a merchandiser would return it to their supplier, and you would get that credited back. Also an allowance. Sometimes you purchase in merchandise and it's not exactly what you want, you're willing to keep it for less money. So let's use my tennis shoes as an example here. Let's say I ordered 200 pairs of teal tennis shoes for $20 a pair, and when they came, they were bright blue. Well, if I call my supplier and say, I ordered teal tennis shoes, but you sent me bright blue, and they were like, yeah, the color was off, we know it. So instead of charging you $20 a pair, we're going to charge you $10 a pair. So you get a reduced price, then you can sell them either at greater profit or on a sale to your customers. So a purchase return is when you return the merchandise. A purchase allowance is when you keep it but you pay a lower price. Transportation costs is something that you add into the cost of merchandise. So the total cost of your merchandise, of your inventory, is how much it costs you to get it on the floor. So the three things I've just talked to you about, terms, returns, and allowances, all reduce the cost of your merchandise, but freight or shipping could add to the cost of your merchandise. So FOB shipping point means that you as the merchandiser pay for the shipping. You paid for it from the point it was shipped to you. And the goods in transit are owned by the buyer, by us, and the transportation costs were paid by the buyer. If it's FOB destination, it means that the seller or supplier pays for the merchandise and owns it until it gets to you. So I'm going to give you a little example. Let's go back to tennis shoes, and Nike is our supplier, and this is their shipping point, and we are KO Shoes. So if it's FOB shipping point, then starting here, we own it, we pay for transportation, and we provide insurance, so it's included in our inventory. Included in the inventory. If it's FOB destination, then while it's in transit, Nike owns it. I'm going to switch to a different color pen because that one's just not working. Nike owns it. Nike, it's in their inventory. Nike pays insurance. And Nike pays transportation. So destination means that the buyer owns it from here on out. Shipping point means that, let's reverse that. FOB shipping point means that the buyer owns it from the moment it leaves the seller's dock. FOB destination means that the seller owns it until it reaches the buyer's dock. So if you are a buyer and you purchase goods that are FOB shipping point, then you pay the transportation costs, and those transportation costs are added into the cost of inventory. If it is FOB destination, then the seller pays for the shipping costs, and you don't add anything extra into your cost of inventory. However, you probably will have paid a higher price for the item to begin with. So this is how it looks when you pay transportation costs. On November 24th, we purchased merchandise on terms of FOB shipping point. So us as the buyer have to pay for the transportation costs. So we would increase the cost of our merchandise inventory by debiting it and then decrease our cash by crediting it. So this is how your itemized cost of merchandise purchases looks. Your invoice cost of merchandise purchases, this is $235,800, less purchase discounts received, $4,200, less purchase returns and allowances, $1,500, plus the cost of transportation in is $2,300. So the total net cost of the merchandise purchases is $232,400. It is different when we account for the sale of this merchandise. So we're the retailer. Up until now, we've been talking about the purchase of merchandise to go in our inventory. Now we're going to talk about the sale of it. So our computation of gross profit is our net sales, net of discounts, returns, and allowances, less cost of goods sold, and that gives us our gross profit. Now, different from purchasing, when we sell merchandise, we have two parts to the journal entries. The revenue received in the form of an asset from a customer and the recognition of the cost of merchandise sold to a customer. So here is how that's going to look on your ledger or T account. We're going to say cash revenue, cash sales revenue, and this is going to be, we got 700 in cash and 700 of sales revenue. But the sales revenue only cost us, this inventory that we sold only cost us $400. So we're going to reduce our inventory by $400 and record our cost of goods sold as an expense for $400. So there's two separate journal entries that take place within the sale of the merchandise. So the one new type of income statement we're going to talk about is not a new income statement. It's the same income statement. We're just going to add a slight change to it, and we're going to account for that merchandise sale, the cost of goods sold in the very beginning. This is called multi-step income statement, and Good Management lists these steps separately. We have our sales, and less sales discounts, sales returns and allowances equals net sales. So that's absolutely showing our sales and discounts we gave other people equals net sales, less cost of goods sold equals your gross profit. And then you subtract all of those other operating expenses, and that takes you to your income from your operations. You add other revenues and gains. So those could be expenses or losses, and that gives you total revenues and gains, and then at the bottom of that you get your net income. We will be working on a multi-step income statement. This chapter we'll be doing a couple of problems with a multi-step income statement. This is what you've been looking at, so we're just going to increase the steps in that. No real change, we're just going to increase a couple of steps. Your classified balance sheet, you will add the merchandise inventory as a current asset. We almost always have cash, accounts receivable, merchandise, and then office supplies, store supplies, prepaid insurance. Remember that current assets are always listed in order of liquidity, from highest liquidity to lowest, to the longest it would take to sell them. And that's it for Chapter 4. I think that's probably pretty quick and easy, and I hope you have a good day.